Yet again, members of Congress outperformed the stock market in 2024, and if we take a look at their returns, quite a number of them actually had triple digits, whilst the vast majority, if not all of them, outperformed and by quite a significant distance. That isn't something that is new. If we were to look at 2023, again, many of them outperforming. In fact, we do have another number of them with triple digit returns. One of them, in fact, 239%, with the S&P at only 24.8 in comparison. But we can show you this, even if we go into 2022, we can see the S&P this year actually didn't perform that well. It had a return of negative 18%, if not all of them outperforming, and as we said, by quite a significant distance. And we just want to show you that the information is there to reinforce that for a very long time, members of Congress continue to perform very, very strongly. What's also interesting to note, it continues into 2025. Nancy Pelosi's husband actually made $38 million worth from the stock market, and that is just from the few weeks that did lead up into Donald Trump's inauguration. And one thing that is interesting to see is perhaps whether or not under Donald Trump's leadership, members of Congress will have some ban in place where they can't get ahead of normal investors. And that leads us into today's episode, where we're going to focus on some recent buying from members of Congress so that we too can have some similar outperformances against the S&P. We've run through each of them in their most recent buys. We're talking over the last few weeks, both Republicans as well as Democrats. We've gone into details of their portfolio. For example, Nancy Pelosi, we can see she has been buying Google, Amazon, in fact selling Apple and acquiring again more shares of Nvidia. Now, if you want to look at solely her portfolio, we did do a deeper dive last week, so check that out. And today we're also going to incorporate other members of Congress, what they've been buying. Now, we're going to look at 8 stocks today that members of Congress have been buying. Each one, in fact, more than just one member has been loading up on, so definitely something to take note of. First one, Amazon. As we already discussed, this is one that Nancy Pelosi has been adding, as well as many members of Congress. And yes, it has performed strongly over the last year, up nearly 50%. Over the last 10 years, massive outperformance of the S&P, up 1,226%. And even though it is trading pretty much at its 52-week high, members of Congress continue to load up, with Wall Street themselves giving this a strong buy, Seeking Alpha also deeming this to be a buy. And even though Quant do give it a hold at 3.49, not far off the 3.5 to flip this into a buy rating. Now, we're also going to look at the growth grade, the earnings, and run each one through our own valuation process. So starting off with the growth grade for Amazon, they do get an A-. Year-on-year revenue growth sits at 12%, a lot better than the low single digit of 2.3% for the sector comparative, but it is below their 5-year average of 20%. And the same to be said for their forward-looking next 12 months, 11% revenue growth, sector low single digit, but again lower than their 5-year average of 17%. But one thing we do quite like is that the earnings per share of this company is anticipated to grow at 22%, with the sector comparative a lot lower at 10.2%. However, as we can see from the other metrics as well, their 5-year average for growth does look higher. We also want to point out the earnings, as we mentioned. First thing to note, we love to see green right across the board. This tells us two things. Firstly, the next 4 quarters, they are anticipating double-digit growth to the EPS year on year, and over the last 4 quarters, quite substantially you could argue as well, they have outperformed market expectations, and that is a good signed 100% track record, meaning that we have faith when we look at December 2025 EPS of 620 that they will hit that, and that means right now their valuation on a forward PE does sit at 37.9. As we said, each one we're going to run through our own valuation process. For Amazon, we get $253 derived from the DCF model. Now, we can show you for the first one how we got there. We have the free cash flow. The average growth is negative 3% due to the fluctuations from positive to negative over the last 10 years. We've gone 20% moving forwards. We have the discount rate, which ultimately gives us our intrinsic value here, $253, upside of 46%. But as always, these growth rates are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any others. But full transparency, for those that believe it should be higher at 25%, $342, indicating 46% upside, and at 30%, this does in fact give $459, meaning 96%, nearly a double from the current value. Today's episode though for Amazon, we do want to be on the more conservative side, so we are using 20%, but it doesn't stop there. We typically like to use a margin of safety starting off at 10%. If we use that, it means it's a buy at around $227. Not quite there yet, so for Amazon right now, you are getting between 5 to 10%. As always though, if you do want to see 15%, we'd see a buy around $215, at 20% around $202. So somewhere between 5 to 10%. With Wall Street themselves, even with the strong buy rating, they see this at $260 by the end of 2025, translating to 11% upside. And as always, do give us your thoughts about these companies below. And as we said, this is one that not only Nancy Pelosi herself has been buying over the last few weeks, but also many other members of Congress. The next stock is Alphabet. Again, many members of Congress have been loading up just over the last few weeks. It's up 35% over the last year. Over the last 10 years, massive outperformance of the S&P again, up 641%. Similar to Amazon at its 52-week high or thereabouts, with a double buy from both Seeking Alpha and Wall Street. Again, quant on the fence, not far off the 3.5 for the buy rating, and we can see, unlike Amazon, they do pay a dividend, although on the trivial end at 0.4%. If we were to look at the growth, even though they do get a C+ rating, both on a year-on-year perspective as well as a forward-looking basis, double digit, well above the sector comparative at low single digit. However, similar to Amazon, these are lower than their 5-year averages for revenue growth. We then can also take a look at the earnings per share, which does come in at 17%, significantly above the sector comparative at 11.6, but not far off their 5-year average of 17.91. Similar to Amazon, we get green right across the board. As we mentioned, very positive to note. We already discussed what this means. So moving on to their December 2025 EPS of just under $9 anticipated, it does mean their forward P sits at 22.3, making it the cheapest right now in the Mag 7 purely on a valuation perspective. If we jump into the intrinsic value today, we do arrive at $215. Just showing you how we've got this, we do have a low, medium and high rate. We've gone for 12%, which isn't only lower than the average of 24% year on year, also lower than the most recent year, so you could argue a little bit too conservative, but you do have the different and respective rates giving you the values. Based on the 12% upside of 8%, and if we do use the margin of safety today at 10%, you would have to wait for 194, so very similar to what we saw for Amazon. Both of these two companies, both in the Mag 7, looking right now 5 to 10% MOS, but as we said, Nancy Pelosi as well as many other members of Congress are loading up right now. Wall Street themselves, even with their rating of a buy, $225 is where they see this at the end of the year, translating to 13% upside. We then move on to a most recent purchase from members of Congress, that is AbbVie, which is up only around 4% over the last year. Over the last 10 years, not far off the S&P's performance, up 181%, trading in the mid to low end of the 52-week range, with a double buy from Seeking Alpha and Wall Street, and this one does pay a very high yield of 3.85%. If we were to look at the growth grade, not as promising as the previous two at a D. Year on year, pretty much 1%, the same as forward looking, and that is not only lower than the sector median of mid to high single digit, but also lower than their 5-year average on both respective accounts. We also notice the earnings per share anticipated over the next 3 to 5 years, 9%, only marginally lower than the sector comparative, but it does it actually quite higher than their 5-year average. If we were to look at their earnings, a little bit inconsistent. The next 4 quarters, they're anticipating 3 of them to be growth, and if we do look back, they have a 50% track record, 2 out of 4 beat. Nonetheless, with the EPS estimate at $12.19, it does give a current forward P of 13.98. Now remember, you can grab a copy of this model by clicking on the pinned comment below. The intrinsic value though for AbbVie is the average of these 3 models, where we get to $207, meaning it has a larger margin of safety than the previous 2 companies. Not at the 20% level just yet, but only a few dollars shy. So for this company, you're getting between 15 to 20%, with Wall Street very bullish. Their price target $210 with the buy rating, and it does look to have the most upside that we have gone through today at 24%. Now before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. We release one once a month, so the new copy for February will come shortly, and this also tells you the upside that Wall Street anticipate over the next year, and you can on top of that grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the next purchase by members of Congress. It is Canadian Pacific Kansas City, up only 2% over the last year. Over the last 10 years, up 129%, underperforming marginally the S&P, trading at the mid to low end of the 52-week range with another double buy from Seeking Alpha and Wall Street, and it does pay a dividend on the lower end of the spectrum at 0.66%. When we do look at the growth, it does come in at a C-, although year on year looking very strong, 28.5% above the sector as well as above their 5-year average, and the same to be said for the forward-looking next 12 months at 18%, above 5.4 as well as their average over the last 5 of 14.4. In terms of the earnings per share, well, that also does look strong in comparison, 14.5 above 11.6 as well as 11.4. Then in terms of their earnings, bear in mind you could argue this industry, railroad, a little bit cyclical. Over the next 4 quarters, they're anticipating 3 of them to be growth, and those 3 itself double-digit rate. However, out of the last 4 quarters, they have only beat on 2 of those occasions. In terms of the EPS estimate, though, 3.43 does right now give their forward P a 23.29 valuation. If we get to the CP valuation model, $81 is where we sit. So for the first time in today's episode, we actually don't see any margin of safety. What this means is that Canadian Pacific is right now trading at its fair value, but for those that are interested, at 10% a buy at $73, at 15 around 69, and at 20 around 65. Right now though, no margin of safety, no premium, trading at the intrinsic value. However, Wall Street disagree, members of Congress clearly disagree, they have been loading up, and they see around 15% upside with a price target of $92. As always, do give us your thoughts as we go along today. We then move on to ExxonMobil, the oil and gas giant, up 9% over the last year. Over the last 10 years, up only 25%. Bear in mind, this is if you had bought 10 years ago. For example, if you had bought at the COVID drop of around $33, you would be up more than 3 times. Right now, trading at the lower end of the 52-week range, another double buy from Seeking Alpha and Wall Street, and it does pay a fairly attractive dividend at 3.64%. If you look at the growth at a D, shouldn't really surprise you given the industry. Year on year, negative 2%, sector median, negative 1%. However, the average has been a lot stronger, and the same to be said over the next 12 months. It isn't looking particularly great in terms of the growth. Their average and the sector median looking significantly higher. However, when we look at the earnings per share, 8% growth is anticipated, a lot better than the sector comparative of 6% and their 5-year average of 3.24. In terms of their earnings, again, very similar to the railroad company CP. It is in fact very cyclical. Over the next 4 quarters, only one of them anticipated growth, although when we do look back over the last 4, they do have a 75% track record, with the EPS estimate giving it a current forward P of 13.8. In terms of the valuation itself, at $119, when we do look at it right now, you're getting at least a 10% MOS, maybe something you actually want a little bit more, maybe around 20%, that would make it a buy at $95. So with the 10% MOS, Wall Street, with the buy rating, very bullish. At the end of the year, not only a nice dividend, collecting it on a quarterly basis, but $133 price target, they see upside of 23%. We then move on to Meta Platforms, up 66% over the last year. Over the last 10 years, up 751, massively outperforming the S&P, trading right now at its 52-week high, thereabouts. Not only a double buy rating from Seeking Alpha and Wall Street, as well as Quant being on the fence near the buy rating, but Wall Street themselves not far off the 4.5 to turn this into a strong buy. They also do pay a dividend, but again on the lower end at 0.31%. And if we do look at their growth grade, looking very impressive with a B+, given the fact that the year-on-year of 23% is above the sector median, also above their 5-year average. And when we do look at their forward-looking, it is strongly above the sector of 2.31 and pretty much in line with their 5-year of 17.2. In terms of the EPS, it is anticipated to grow a lot higher, 18.3 than the 11.61 comparative, but it is pretty much in line or thereabouts with their 5-year rolling. Very impressive earnings, not only double digit over the next 3 quarters anticipated, but we can see over the last 4 100% track record, and based on $25.44 EPS estimate, the forward P sits at 25.5, not far off Alphabet around the 22-23, but as we mentioned earlier, Alphabet is the cheapest trading right now in the Mag 7. Intrinsically though, we get $657. It is the DCF model, so we will show you the different rates we have used. Again, you could argue very conservative at 12%, given the average over the last 10 years has been 36 and the most recent year in the triple digits, but you can come up to your own conclusions as we have shown you the available data. In terms of margin of safety, you don't really get even a 5% right now, so we believe Meta Platforms trading pretty much around the fair price. Wall Street, even though we did see a near strong buy rating, they see this at $700 over the next year, indicating 8% upside, but members of Congress nonetheless are loading up. We then move on to Walmart. Yes, members of Congress are buying this company that is up 77% over the last year. It has in fact outperformed the S&P over the last 10, up 226, and also trades near its all-time highs. And Wall Street, again, with a buy rating, but not far off the 4.5 to turn this into a strong buy, and it does pay a dividend of 0.88%. If we look at their growth, they do get a C. We do in fact notice year on year above the sector, pretty much in line with their 5-year average, but moving forwards 5.2, marginally above the sector and also marginally above their 5-year rolling. In terms of the earnings per share, nearly 10% expected, which is better than the sector comparative as well as better than their 5-year average, so it does look positive for this company on the growth aspect, and we also get green right across the board. We love to see this. January 2026, so pretty much their forward P right now is around the 34-35 mark. You could argue on the more expensive end, but again, it does look good in terms of the growth. Members of Congress are also adding. However, what it comes down to is when we put it through our valuation right now, we actually see this not trading at a margin of safety level, not trading near its intrinsic value. We actually see this right now trading at a premium. So if you were looking at this and wanted a 10% margin of safety, we would see this at $74, at 20% around 65. But nonetheless, members of Congress are buying. They also see, in terms of Wall Street's expectations, 17% upside with a price target of $110. But this could be a company that people do continue to dollar cost average into, has performed very well over the last year, is trading near its 52, if not at its 52-week highs. But as always, give us your thoughts. We then move on to the Home Depot, up 19% over the last year. Over the last 10, nearly 300%, massive outperformance of the S&P, trading at the upper end of the 52-week range, another buy rating from Wall Street, and it does pay a dividend around 2.2%. If we were to look at the growth grade, it gets a D-. As we can see, year on year as well as forward looking, not that impressive at all, considering the sector is actually higher, even if it is marginally, and the same to be said, they do lag quite significantly their 5-year average. Having said that, we also notice the EPS is lacking at 4% anticipated, significantly lower than the sector comparative and lower than their 5-year. In terms of their earnings, we do obviously, as you can see, like the fact it is green right across the board, and looking at their forward valuation right now, it does sit at a forward P of 26.3, not that far off the S&P. Our valuation comes to $441, pretty much in line with Wall Street, where they see this at 6% upside, and in terms of a margin of safety, whilst it's not bang on the 10%, you are getting somewhere between 5 to 10, and as we said, very limited in terms of what Wall Street see. Nonetheless, they have given this a buy near the strong buy rating. As always, do give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter. We are dropping a brand new fresh copy Monday morning, and grab those spreadsheets. Also come and join us in a Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.